Welcome, folks. This is a new tutorial video. I haven't done something like this in a while. And for those of you that have seen the previous one, you will notice that this is a very different format. I am adding myself into the video. And I think it can help. If you guys see my face and see my gestures, maybe the concepts will be easier to understand. So this video in particular is called Introduction to the NDLA. And the subtitle, I guess, is fun. It's a funny subtitle in my own way, and some of you will get it or not. I'll let you Google the inspiration for the subtitle. So the thing is, we get new people in the room all the time, and I always get the same question over and over. What is the NDLA? How to read the NDLA? So this presentation is for those of you that look at the NDLA and go crazy like, man, what do those numbers mean? And also for even all members that want to dig a little deeper on the origin of the NDLA, like why are we using it, and how come it provides an edge, no? So without further ado, let's start. So there is an edge, of course. If you have been in the optimizer room, you'll notice that everything we do has an edge. And what is the origin of the edge? So the origin of the edge for this particular trade has to do with order flow. So in other words, how puts and calls compare during normal trading for SPX options. And you will notice that index options, SPX options in particular, are very peculiar. There is a tremendous bias towards puts. I mean, puts are the most traded option in SPX, and you will notice that volume for puts is massive. They are consistently trading. Doesn't mean people think that the market is going to fall. Doesn't think that means that the market is going to crash. What that means is that puts, in particular index puts, are very well suited as protection or insurance. So if you're running a hedge fund or not hedge funds, but I mean a mutual fund, or you're running a big bank, or you're running a big diversified portfolio, you want to have protection on it all the time. And the most convenient way of protecting your portfolio is to use index options like puts in SPX. That's why you see puts traded so frequently. They are incredibly liquid. Puts are tremendously liquid. And the reason for that is because they are used as protection. On the other hand, we have calls. Calls in index are not, they don't trade that much. No, they trade probably not even half of the volume, of the daily volume of SPX options are calls. So we have to wonder why. Well, the reason is that not many, at least at the SPX index level, you don't get that many speculators using calls. There are many reasons for that. They are too expensive in terms of notional. I mean, they are really kind of expensive. and as I say, the index options were designed to provide protection, and that's how it's done. If you see calls trading, most of the time, those calls are part of short legs. In other words, people are selling them. And they are selling them because they are either doing protective collars, or because they are doing a variation of cover calls against a diversified portfolio, or is kind of like the trade du jour of volatility selling strategies. When you have a volatility selling fund, or a volatility fund in general, they tend to sell calls for some reason. Don't ask me why. I will never sell them, but that's what it is. So the order flow in index options is lots of put buying and lots of call selling. And that's an interesting combination, but very, very interesting combination. Like, why? So for now, let's say that situation creates an interesting asymmetry that is only present in the index world. You will not see this kind of asymmetry for single options, for instance, like Apple or Tesla or Netflix. There is lots of speculation on those single names, on those single stocks, while in index is a kind of different structure. So that's why the NDLA applies only to SPX. I don't have an NDLA equivalent for Apple, and I don't have an NDLA equivalent for Tesla, no? So what is the situation that it creates? How we quantify the situation? And it's right here. It's called, it changes the volatility smile. Let's see if I can get some annotation here. Yeah, I get a pointer. So if I don't look at you, it's because I'm looking at the screen. I have to kind of these two things. And so let's look at the screen. Uh, so this is called a volatility smile. The volatility smile has on the x-axis is just the strikes of every option, and on the y-axis is the implied volatility of the options. In a perfect theoretical universe, this graph should be on a straight line, like flat. Like the implied volatility of all the options should be exactly the same. No, I mean that's kind of the theoretical framework, nonetheless. Believe it or not. But in practice, and in fact, since 1987, it never happens again. What happens is puts tend to be overpriced and overpriced by a lot, while calls tend to be underpriced. But so, oh, sorry about that. This is kind of the Macintosh magic mouse that switches these things for me. So notice that there is this negative slope on this side. You know, we have this negative thing coming, and it kind of flattens, and then it becomes positive again. So that shape with those slopes that you see there on the screen is what is called a skew. A skew is basically the slope of this curve. That's what a skew is. So and a skew is very simple to analyze. So you can see that in this area, well, for lower strikes, we have tremendous amount of negative skew. You know, that's what we see right now in this moment. And in the positive area, we have tremendous flat, but then it starts not tremendous. It's kind of a small positive skew. So tremendous negative and small positive. And that is structural. No, like you will see this shape like this. It's not even called a volatility smile. Some people call it the volatility front of SPX. It's very it's prevalent in SPX options for pretty much any expiration. So that in particular, that phenomena has an effect on binary options. And okay, before you get scared, yeah, I know no one trades binary options, but let's mention that skew affects the pricing of binary options. There's a whole mathematical framework behind it and a reason for it. So yes, how it is affecting binary options? Binary options are affected because skew makes puts incredibly cheap, negative skew, I mean. So in the region, in the previous region here in this area, this negative skew is making all of those binary puts, listen to me, binary puts, not puts, but the binary ones are very, very cheap, which is kind of the opposite of the normal things. No, the normal things and the normal puts are incredibly expensive, but the binary ones are incredibly cheap. Also, on the flat area, well, nothing happens. You know, skew is kind of flat. There is zero skew, so in that area, there is no overpricing or underpricing. However, on the positive area of skew, when the slope becomes positive, then we have underpricing of binary calls, which is interesting because calls are mostly cheap, like normal calls, and now we have binary calls that are even cheaper. I think I like this situation. Like really, I like this kind of curve. So okay, so now we come back. There are no binary options, of course. The market for binary options evaporated in the US long ago, and there is, even though there are a few of them, like VIX has a few binary options, and we have a few exchanges like Nadex. There is really no market for them. So we need to replicate them, and they are easy to replicate with vertical call spreads. It's the easiest thing to do. You know, we just use vertical call spreads and we replicate this thing. So you remember, when I talk about binary options, it's not just theoretical. We could actually trade binary options by replicating them. So now we arrive to the meat of this presentation. What is the meat of the presentation? Is that binary calls contain upside edge. There is a tremendous, tremendous upside edge in binary calls, and in particular near term. Why near term? Because this skew here in this area, this is for October 5th, which, this video has been recorded on the Saturday, September 22nd. So this is actually 2 weeks from now, and it is based on prices from yesterday, from Friday at 4. So uh, you notice this skew. The nearest term, as you get closer to expiration, positive skew become more prevalent. And if we go further, I guess I should have added a slide for that. But as we go further in time, the positive skew is less and less. So near-term options exhibit really nice positive skew, which means that near-term binary calls are tremendously underpriced. And that's what we want. We want binary calls that are near-term, like 7 days or less, that are incredibly underpriced. So not only that, they actually are underpriced versus historical probabilities. And we'll see it here. And here I present to you the naive strategy. So the naive strategy is a strategy that, like, I know some members on the room have been using. I use it from time to time with certain variations as well. The naive strategy just comes from looking at the time series. Like, this is public information. This is not secret, but I mean, I keep it secret between us. No, but any of you could develop the same strategy. What is a naive strategy? A naive strategy is basically just look at the time series, find all of the returns of SPX, every return that you can imagine, and look for moves of 1% or more every week, and see what you find. And so you will think, I mean, in your head, 1% in a low volatility environment like the one we have right now for SPX seems like it should be really infrequent, but it's not infrequent. It happens 30% of the time. That I will say that's kind of frequent. No, it's not half of the time. It's not 80% of the time. But I mean, 30%. It is frequent. I will say it's very frequent. So, uh, given that fact, you will expect that option dealers will price a binary option to play that. No, I mean, I'm playing the 1% up move. You will think that option dealers will be pricing that at a fair price. No, the fair price of a binary option for this kind of move will be 30%. No, however, they are not. They are actually being underpriced. And why? Because of the phenomenon I just described in a couple of slides back. They are being underpriced because skew enters into play. Therefore, we have this tremendous edge on this trade. So the edge of the trade is, and I'm showing you here for an example right now for next week, for next Friday, September 28th. The 1% binary is the binary for 2,960. And if I quote it from normal options, now I'm doing the translation between dollars and binary prices, the cost is actually 18%. So it's heavily underpriced. It's not like, oh, it's like 25%. No, it's 18%. That's a tremendous amount of underpricing. That's something where we can take advantage on. And it is a statistical misprice. It really doesn't align with what we have seen for the last 9 years or 10 years, basically. So what is the edge? So if you remember your statistics, you will remember the definition of edge. Now, the definition of edge is just the probability of winning times the profit minus the probability of losing times the max loss. Now, that's kind of as edge is defined in finance and even gaming, no, when you bet in a casino. So from this real example, you notice that I run all these numbers and the edge is plus 12, which is really the difference between 30 minus 18. I just wanted to use the full equation to show that it works. No, it's not surprising. What is surprising is a positive edge. So positive edge has tremendous implications. Positive edge means that if we do this trade over and over and over, we are going to win sometimes, we are going to lose another times, but at the end of the day, we are going to accumulate positive profit, and that's interesting. I mean, this is really an interesting mispricing in the market that can be exploited and that we actually exploit. So so right there, that's a naive strategy. So what is a naive strategy? The naive strategy is, okay, if the binary, like we check the binary every day. Every day we check the binary for that, for the 1% move, and it should be priced around 30%. But if we find the binary that is actually being underpriced, the prices of the binary changes based on implied volatility. So if we find the binary that is actually underpriced, then every Monday, Wednesday, and Friday. And why those days? Because those are the days that options in SPX trade. And if we could have SPX options trading all the time, then I will take this trade all the time. But the trade is only taken on these days because that's when they are available. So they are available to me. So we do that every Monday, Wednesday, and Friday. We buy the 1% binary up, and we profit. Of course, it sounds easy, but it's not that easy. Remember that positive edge doesn't mean a sure trade. Positive edge means that in the long run, doing this thing many times along the year, let's say 150 times, if we're doing this every week, then the winners will overtake the losers because there is positive edge. That's what it means. But it doesn't mean that it is a free lunch. It doesn't mean that you are going to get a winner every time. In fact, you will expect to get winners only 30% of the time. No, that's what it is. You are expecting winners to be only happen at 30% of the time, which is a low rate of winners. However, because of the mispricing, you will make money on this trade. No. So, okay, before improving it, the discussion is that this trade is it works. No, we have done it. You can analyze past performance, and you will see that it works really well. So the question is, can we improve on it? Can we create a strategy that also give us to exploit the nice positive edge and that give us a success rate higher than 50%? I mean, because then that means that I will be losing like many losers and just a few winners, and there is always this psychological effect that man, I'm kind of losing, I want to win. But in my case, it's just to make the trade more efficient. I don't like the inefficiency of the trade because the losers, not only the cost of the trades accumulates commissions and exchange fees. So can we develop a variation that is better than the original? And the answer is yes, we can. We can really develop it. It does exist, and how? That's the question. How we develop that strategy? So there are many approaches, but I'll introduce this approach, which is my approach. My background is in all this. I am a like certified nerd. I will say that I have an official degree as a nerd. So I love all these things that are mathematical, and I love deep neural networks. Deep neural networks is just the most, not recent, I mean, they have been around for quite some time, but they have taken over relatively recently, and it's one of those approaches on machine learning that is really efficient, is really effective, works really well. And in this case, I'm using deep neural networks to help me identify patterns. In particular, that now in Facebook, they can identify your face, they can identify colors, shapes, all sorts of things. So if they can do that, which is a very complex thing, we could program one to do something very simple. The pattern that I'm looking for right now is the pattern for the 1% move up every week. Can we identify a pattern like that with machine learning? The answer is yes. And so we have the NDLA. The NDLA is born, and is born as, it stands for the New Deep Learning Algorithm. So that's it. That's the explanation for the name. There is nothing fancy behind it. It's just kind of short of imagination to put names. It's called NDLA. And it's a new deep learning algorithm, and it takes 11 different inputs, 11 inputs which are available to most of you, and it just gives us the probability of seeing a 1% move up in the market within the next 7 days, or I mean after 7 days, 1% or more. Remember that historically it happens 50% of the time. So basically what this algorithm is trying to do is to identify those times when it happens. So we don't have to waste our time sorting through the times where it doesn't happen. Okay, so, and this is a question that I get all the time. I mean, this question, what are the inputs to the NDLA? The inputs to the NDLA, as you can see, are the return, which is the daily return that we have. So from yesterday to today, what is the daily log return? The HV5, or in other words, the realized volatility for the past 5 sessions. So we have a 5-session volatility window. So in this case, I'm kind of involved in the most recent realized volatility. I mean, the action, the most recent action in the market. The market has been very volatile. It has been very calm. You know, I'm trying to involve that here in this computation. And I include M5 and M10, which for those of you that use the momentum center, you will notice that I plot the M5 momentum all the time. So the M5 and M10 measures momentum. They sound complicated, but it's not really complicated. It is just the average of log returns for the past 5 days and 10 days. So M5 and M10. So it kind of captures the trend in the market, like what is the price trend for the past 5 days, what is the price trend for the past 10 days. We also have BIX9D, which is just a rename. It used to be called BXT. Now it's BIX9D because CBOE wants to copyright all the things BIX. I hope I am not running afoul of the copyright here. So it's just a published value for 9-day volatility. Is the short-term implied volatility. So it's the implied variance actually more exactly for the next 9 calendar days. We also have VIX, which is very familiar to you, is the 30 days, the monthly implied variance in the market. And we have VIX that some of you might or might not know. VIX is the volatility of volatility. It's also a monthly value. So it's kind of measures it's the VIX of VIX, if you think about it. Now, like VIX is the implied variance of XPX. VIX is the implied variance of VIX. Then we have 2 amounts here that are not found in any place. You know, there has to be secret sauce, no, in any place. You must forgive me for introducing a secret sauce component, but I mean, I found that really useful. I found having secret sauce as something that really helps. So O2, or well, in fact, it's not O2. It's just because I'm too lazy. I cannot write the Greek. Not even in Greek. This is a Latin thing, but this is ambiguity. O2 is ambiguity. And P is the probability of negative returns, which is a concept related to ambiguity. They are very, you know, they go hand to hand. And you notice that when I post ambiguity by the close, I post ambiguity is the black line and probability of negative returns is the red line. So they are used here for the NDLA. And I also use the month of the year and the day of the week as seasonal parameters. So that's it. Those are the 11 things. And I trained this thing, I trained the neural net with historical data for the longest time. I mean, but with a caveat, this has been trained since 2009. And if you notice something, what is the common denominator of market trend since 2009 is that the market has been in an upswing. Now the market has been we have a bull market. That's the common denominator. So of course the NDLA is a bullish thing. It's trying to identify when person moves up. Of course those things are within the context of a rising market. And if the bull market ends at some point, and it will end, no, if you ask the EWT experts, it will end. So we cannot use the NDLA anymore. And in fact, back in February, it didn't work much during that period. So something is to keep in mind. This thing works as, you know, as long as it works, as they say. Someday it will stop working, but right now it is working and it's useful. And so, okay, so in the mind is, what are the statistics of the NDLA? What are the results we have seen recently? Okay, so during normal regimes, and like right now that we have been in a long gamma regime for quite some time, the NDLA works really well. It didn't work back in February. I must tell you, it didn't predict the correction. And after the correction, given the tremendous amount of realized volatility, it completely went nuts. So it didn't work at all during February. And it took some time for it to start working again. It really took some time for it to come back to life. But since April, the stats for the NDLA has been this one. We have a precision of 7.8%. 70 point, no, not 7 point, 70.83%. That's fantastic. That's higher than 30%. And so I will take it now. That means that we succeeded with this algorithm. This algorithm actually is very successful. It's helping me identify, or it's helping us identify the 1% moves up. So precision is fantastic. Now look at recall. What is recall? If you are familiar with binary classifiers, recall is kind of a measure of false positives. Low recall means that we missed positive signals that should have been positive, we missed. It's kind of low. I mean, it's around 55%. I would say that that's lowish. What that means that we have a lot of false negatives. So in this case, I don't care. Some of you might care because of you guys. You tend to use these things for the craziest purposes. The NDLA is only for positive signals, but I know a bunch of you also look for negative signals. But look at this. We have a bunch of false negatives, but we don't trade them. I don't trade them. So it really, to me, it really doesn't matter. Low recall, I don't care about low recall. What else? I want to mention, I want to mention partial precision. Partial precision is something that, in fact, I got a question yesterday about that. Partial precision is what happens if the move doesn't happen in the 7-day window, but before. So I mean, we are predicting a 1% move up within 7 days, but what happens if the move happens with 3 or 4? So we get an early hit of the signal. So the signal, we get this hit early on, and how successful are we? Well, we are tremendously successful with that. We have 87.5, almost 88% precision for this kind of thing. So the NDLA is actually really good. I had been tempted to train it for that. So, but I don't know. I don't have the time to retrain the algorithm, because this is, remember, the NDLA is trained for the 1% move up after 7 days. So the question is, what will be if I actually train it for within the 7 days? So kind of a different algorithm. The algorithm is, no, look for the 1% up at any time, on any day, within the 7-day window. I don't know. I should retrain it. But even without that training, this algorithm is picking those, is having a success rate of 87.5%, which is not bad at all. Okay, now how to read the NDLA. Before going to how to read the NDLA, I must say that, okay, we have high precision and high partial precision, and we also have the edge. So we also have the naive edge. So I will say that all those things combined should do for a fantastic systematic, or not systematic, but I mean discretionary trade based on this system. I don't know if that's systematic or not. Systematic sounds like it's consistent and continuous, but like doing the NDLA should work fine. But we'll see that there is a drawback to this strategy. I mean, we won't become rich with it because the following drawback. But so let's go to how to read the NDLA. So this is an NDLA table. I am looking at my screen. So we have a summary section, and the summary tells us if we have a positive signal for next week or a negative signal. So in this case, because this is from yesterday, from Friday, we got a negative signal. So the signal is completely negative. That means that the NDLA algorithm is not seeing a 1% move up next week. You get the date of the prediction. Ignore this for now. You get the probability of the prediction, and this is kind of the target area, which is only this is just something. It's a shortcut, no? This is the shortcut for you. This is the 1% move, no, based on the closing value of XPX. So when I generate these tables daily, the only thing that changes is this first line. That's the only thing that changes, the first line. Everything else is just for references, historical references. Only if you really want to pay attention to it, don't get all the bunch of numbers get you confused. Only focus on the first one. The first one is the one that contains information, and this is the prediction date. So sorry about that. So what does it mean? Why do I add all this bunch of stuff here? So I add all of the rest is just so we can see how good or bad the algorithm has been in the past sessions. So this is just for historical purposes. So look, back from September 6th to September 14, for instance, we have had all negative signals. Negative signals, by the way, is any signal less than 0.5, because this is a probability between 0 and 100, no, or between 0 and 1. I mean, in terms of mathematical terms. So anything lower than 0.5 or anything lower than 50% is a negative signal. So we have had negative signals for a long time. And if you notice, R5 is actually the 5-session return of the market. In other words, this is the weekly return of the market. This is what the market return weekly. And you can tell right here that that the negative signals have been fulfilled, because remember, this is actually looking for a 1%. So most of the stuff is less than 1. We have one exception. See here? This is a false negative right here because we got 1.15%. So we went over the target area, which was 2,900. So probably we closed above 2,900. So this is a false negative. But then everything else, including yesterday with a tremendous move, was also a good negative, although kind of close, not kind of pushing it close to the 1%. But then look at the hi-fi is like the highest value in the period. Like notice that even though we have negative signals, we have seen within the window. I mean, we have seen 1% moves, and then kind of the market comes back. No, that's how it works. The market goes up and then comes back. And so we have had a few of those, a few spikes, if you will, higher than 1%. So that's how you read the NDLA. So for most of you, just look at the summary. Like, if there is a positive signal, we do a trade. If there's a negative signal, just ignore it. And this is only useful for those of you that are tracking performance, or just want to, like El Mano, that likes to do some variation of the strategy, and he uses the probability in a different way. Okay, so now becomes the question how to trade the NDLA. Like how do we take advantage of this neural network for trading? Well, given that it has such an excellent precision, which means, I mean, tremendously excellent, I will say is fantastic, then when a positive signal is generated, whenever we see a signal higher than 0.5, we go in. I'll go in, no? And we buy a binary call for that target area. But remember, there are no binary calls in the market. Or I mean, in SPX, it's hard. They are hard to find in legal ways. So we replicate them, and we replicate them with a vertical call spread for the target area. So here is the replication. The replication is just a vertical call spread with the short leg. The short leg is the target. Okay. And where the long leg is just 5 points below it. And the question is, why 5 points? The 5 points is because right now, that's the minimum width of the strikes in SPX. Someday, we'll get infinite strikes. Well, right now, we don't have that. we don't have continuous strikes. We have strikes every 5. Someday, I know we'll get them with decimals and everything. But right now, we get it spaced. At least for 1 week expirations, we get a space every 5. So this is basically a very tight vertical call spread in SPX. And remember, the target is the short leg. I notice most people, when they think about it, they use the target here as the buy. No, the target should be the sell, and the buy is 5 below. Also, a very important parameter, the cost of this trade, if I look here, the cost of this trade should be less than $1.5. It should be less than 1.5 per contract. And why less than 1.5 per contract? Because I mentioned that there is edge for the naive if it's priced at 30%. So the 30% of 5 is 1.5. So that's kind of my preference. I never go in for things that higher than 1.5. In fact, I never buy this spread if it's priced higher than 1. I tend to get the spread when it's like 0.7, 0.8. That's kind of like, I am a cheap person, I guess, no? That makes me cheap. I like to look for very cheap binary calls because they have way more edge than the expensive ones. But in general, you can, if it's lower than 1.5, it's a good entrance. And then some notes. Okay, so this is not a couple of things I want to mention here. First, there are no free lunches in the market. There is no free money laying around that you can get from the market. There is nothing. The NDLA is just a pattern recognition algorithm. Remember, it has lots of false negatives. And remember, precision is not 100% either, no? But yet there is positive edge. Positive edge means accumulation of profits. The profits overtaking losses, but there are going to be losses, and you have to trade this consistently when you see a positive signal. So that's the second important point that I have here in the presentation. Positive signals, folks. Don't use the NDLA to interpret or extract meaning from negative signals. There is no point. There is no meaning, and the reason why negative signals is because they're too ambiguous. There is too much ambiguity for a negative signal, because it could be a false negative. This thing, it could be a false. You notice that the recall of the algorithm is kind of on the low side, so it could be a false negative, or the market can actually move up, but not quite 1%. It could move 0.9999, and yet this thing will be working fine. You see my point. So the negative signal doesn't mean that the market is going to fall. The market could just move a little bit. The market could remain flat, no movement whatsoever, just flat, flat, flat. Or the market could fall. So there are too many possibilities for a negative signal. So they are really, to me, they are useless. But anyway, that was kind of the presentation that I wanted to make. I don't even know how many minutes I've been, oh my God, 56 minutes. I'm sorry for the long presentation. I wanted to make this about 10 minutes long. But you know me, I tend to talk a lot. And if you have questions, just, ask the questions in the room, send me private messages, post, don't be afraid, folks. And I hope you actually enjoy the little tutorial. Take care, guys.